A very good morning to all. I am Professor Anjali Gupta from the Department of Commerce, Atmaram Sanatan Dharm College, University of Delhi. I, along with my colleague, Ms. Monica Saini, will be throwing light and discussing the event study methodology in the next couple of lectures. Whenever we are the study, that is the presentation or the lectures, uh, series of lectures on event study methodology will be focusing on first the concepts of the event study methodology, the different methods and the techniques that are going to be used in the event study that are being used in the event study, and definitely the last and the least, not the least, the practical aspects of the methodology or how it is being applied using the different softwares. Whenever we are talking about the event study methodology, we have to look into the basic theory of the finance, which always suggests that a capital market reflects all available information about the firm in the firm's stock prices. Based upon this theory, one can always study that how a particular event is going to have an impact on the firm by quantifying the impact of the event on the firm's stock. Here comes in picture the event study methodology, which is developed in order to perform an analysis where the focus is always going to be on stock returns. The returns which are based in the event study, the event study is going to quantify an event's economic impact using the abnormal returns. This particular methodology, as is being established, tries to find the validity of the semi-sound form of efficient market hypothesis, which says that asset prices already reflect all publicly available information in relation to the firm, and thus it is not possible to ever earn abnormal or excess return using the fundamental or technical analysis. In the event study methodology, as is being established by McWilliams and Siegels in 1997, the study determines whether there is an abnormal stock price effect associated with an unanticipated event. From this analysis, thus, the researchers can infer the significance of the event. What we try to find out is in the event study methodology that whether there is a presence of abnormal return, which means that there is going to be a violation of the efficient market hypothesis in the semi-strong form. The market, if it is efficient, it is going to show the immediate reaction to the event and only on the announcement date. And there should not be any subsequent reaction on any later trading days. So if there is any subsequent reaction, definitely it is regarded as an abnormal return or an abnormal reaction, and we must try to find out that why it is happening. Before we move on further in the event study methodology or a discussion on the same, we must just try to have a look on the classical references or the seminal work which is being carried out in this field. The first and the foremost study that was being undertaken was one by Dolly in 1933, then by Ball and Brown in 1968. Definitely a seminal work which has given a new dimension to the event study methodology was the one by Farmer, Fisher, Jensen and Roll in 1969, which focused on the stock splits. Also, in relation to the short-term performance studies, which was being undertaken by Brown and Warner in 1980 and 1985. Then also the long-term performance aspects were being studied by writer Logren and writer in 1995. Long-term performance studies were again undertaken by Barber and Leon in 1997, Leon, Barber, and Desai in 1999. Potential problems in the existing long-term performance was undertaken by Masuli Norley in 2000, Michelle and Stanford in 2000. Then there was a study by Ehren 2008, also a study by Kothari and Warner 2006. So these are some of the seminal work which were being undertaken in relation to the event study. There is also work by Corrado in 2011 that is worth mentioning here. Now, whenever we are talking about event study, what we try to see that we have to first find out that what kind of events that are going to be coming up for the purpose of the event study. The events may be the one which are within the firm's control, that is those which are going to be undertaken by the firm, whether they have to be undertaken or not. That is the prerogative or the decision of the firm, as is the example of stock splits. Also, can be events which are beyond the control of the firm or the company, as we may say, like the macroeconomic announcement that is really going to affect the firm's future. Also, there can be the events which can be examined, maybe like mergers and acquisitions, dividend announcements, issue of the new debt and equity. There can be the IPOs, that is the initial public offer announcement, buybacks we are talking about. So these are some categories of the event or some types of the events that are usually being studied in the event study methodology. There are different types of, when we try to categorize that whatever seminal work that has been undertaken by different researchers, we see that the different types of event study may be, some studies are those which are focusing and are regarded as short term, are the one which are going to focus on the efficiency of the market. That is, they try to study that what is, or the speed and the accuracy with which the market is going to react to a news or to an event, as as is being term used here. Also, they may be the one which are going to evaluate the extent to which a company or a firm is going to respond to an event that is happening. Information impact researches is what is the type of event study. The third category of the event study may be the one which examine that whether there is a presence of abnormal return or not after segregating the securities into different subsections. And what we try to analyze here is the variation of the abnormal return among different subsections. A very seminal work in this regard or in this type of researches is one by Bowman in 1983. Now, important aspects when we are talking about the event study, there are certain important terms or certain important concepts that we need to be quite clear about when we are talking about this methodology. The first important concept is the one which is relating to the event day. That is the reason or the event or the particular factor that we want to study. That is what it is there. So what we need to do when we are talking about the event day, or it is going to be regarded as, when we're talking about the event day, it will always be regarded as the 0 day or the one which is our study. That is what we do. And what we need to do is that first we need to define an event. Yani ki, what is the event, कौन सा इवेंट है या कौन सा स्पेसिफिक रीजन है जिसे हमें स्टडी करना है. दैट इज व्हाट वी ट्राई टू डू. वी ट्राई टू find out specifically the one event or the one reason that is going to cause an impact. The impact of that particular reason or factor that we want to study is what is, we term it as the event day. Then also it has to be very specific is what is required. That is, it should be having a specific date, that is the date on which it has occurred. So what is being, as you can see, that we have to be quite clear then that when the event has been occurring, we cannot say that in 2-3 days or something. We need to know the exact date of the event. Dating in this case is quite a problem because sometimes we don't know when the information has come in relation to the event date, maybe like announcement when the board meeting is happening. It is nowadays, definitely the board meeting is something where the things are being specified, but definitely we cannot, in many cases in the study, we are not able to exactly point out the point, the day on which the particular event or the particular factor is happening. So a very important factor of the event study is that we need to know the exact date of the event. If we do not know that, then definitely we cannot undertake, we cannot have very exact and robust result in the event study. Then the next is that we need to decide about like what the event date that we are studying. We need to find out that whether we are talking about the date in terms of the weekly, daily, or monthly. Monthly returns is what it is there. Also, what we need to really know is that when we are talking about the event date, we have to ensure that we should try to control and ensure that it should be a date which should be free from any noisy or the confounding events. On that particular date that we are choosing as the event date should not be a day when a lot of other events are also happening, because in that case that particular date will be regarded as a noisy day when the effect on the return is not happening because of just the factor that we are studying, but it may be because of the other factors. So when we are choosing an event date, we have to be sure that first it should be a specific day. It should be a well-defined factor that we are studying, and definitely it should be a day when it should be free from any noisy events. There should not be any other event, any other factor which may have an impact on the abnormal or on the returns of the company should be happening. Now, the next thing that we need to know about is the event day window. Now, when we are studying the event methodology, in the event methodology, we just not try to see the effect on a particular day. We must try to see typically the effect on the days before and after the event. Now, it is in different research papers, or the different researchers have taken different days as the event day, which we will be just discussing when we are going to go through the timeline of the event study. But definitely it is that when we try to define the event window, we try to take it as a time period around the event day. That is a time period before the event and a time period after the event. So it can be a time period, for example, minus 10 days, that is 10 days before the event day, and plus 10 days, that is 10 days after the event day. So in this way, as we can see in the slide here, that the time period may be from minus 10 to plus 10 days, that is 10 days before the event and 10 days after the event. The event window may vary from minus 1 to plus 1 day, minus 2 to plus 2 days, minus 5 to plus 5 days, minus 10 to plus 10 days, as is being given, shown in the presentation here, minus 20 to plus 20 days, minus 30 to plus 30 days. There is no hard and fast rule as to the time period for which the event window has to be there. Depending upon our study or the factor that we want to study, we decide about the event window size. Now, when we have, like, as we are, as is being shown in the slide here also, if, for example, we are trying to find out that whether the firm once will become a member of a stock index, what will be the impact on its share prices, what we try to do is that we try to study a time period, maybe 10 days before, 2 days before, 5 days before the event period, and 2 days after, 5 days after, 10 days after the event window, and we try to then study the impact. Definitely, as so in crux, what is really required is that we have to precisely define the date on which the event has occurred. Definitely, we need to know the number of days or the time period for which we want to investigate the impact of the event. For this, we need to be quite clear about the event window size. Also, the event window will be maybe of a shorter duration or for a longer duration, depending upon the effect time period for which we want to study the effect, whether we want to study the effect for a short period of time or we want to study the impact for a long period of time. Also, what is, I would like to mention here the work of McKinley 1997, who showed that the power of the event study in order to detect abnormal performance is much greater than the daily data that are employed rather than the monthly, quarterly, or annual data. That is what we are trying to say here is that we are able to better detect the impact of an event in the form of abnormal returns if we are able to study or get hold or use the daily data instead of the monthly, quarterly, or the annual data. Now, besides the event date and the event window size, the next time period that we need to study is that of the estimation window. Now, estimation window is the window over which we want to study. That is, estimation window is going to give us the parameters that we use in order to estimate the normal or the expected return. So when we are talking about the event study in a simple way for a non-finance person, I can simply say that all the effect that a particular event is going to have on the prices of the share prices should happen immediately on the day on which that particular event has happened. But if it is not happening, then definitely it means that there is some effect. We should try to find out theory से हम अलग जा रहे हैं. We are going different. That is, we are not able to prove or the efficient market hypothesis theory is not happening, and definitely we try to find out extent to which there is a deviation from the normal return when there is no effect. Whatever is the effect that is happening on that day that is not happening, we try to find out the extent to which there is a deviation. Now, in order to find out that what is that normal return, what is the normal return if the effect is not happening, that normal return we need to estimate. In order to estimate that normal return, we need parameters. We need a comparison parameter. For the purpose of finding that comparative parameter, that is the normal or the expected return, what we need to do is that in order to calculate that, we need to have some parameter, some estimating period from where we calculate those parameters. So that estimating that time period which is used in order to estimate the parameters that we use for the purpose of calculating the normal or expected return is what is the estimation window, or as we say, the estimation period. Estimation period again can vary from time period depending upon our nature of study. It may vary anywhere between 100 to 300 days or longer period, that is the 360 days also. But usually the researchers try to have not a very larger window, because as the window becomes larger, more and more noisy events or more and more events are being included, or are more and more factors are affecting the prices. And that means that the prices do not seem to be very pure because they are being affected by events other than the one which we are studying. So as a result, our estimates may be wrong. So what we try to do is that we try to have not a very long window, but at the same time, it should be a window which should be just enough to take care or give us the estimates that we want to have. Now, as I was saying that we are going to discuss the timeline, then definitely this is how, what is the timeline that we have discussed till this point of time. First, we are talking about the event day, which is always going to be regarded as the T0 for us. Then we have a estimation period, which is going to be the interval that is the T0 to T1. Also, the event window is going to be there, which is going to be a time period from T1 to T2, and definitely a time period after the window, which is going to be the T2 to T3. So this is how we are calculating, or the estimation window. That is, first we have the estimation window, then we have the event window, and then we have the event day, and last and not the least, we have the post-event day. In the next presentation, we will be discussing further on this timeline and how we just calculate the abnormal return using different methods in event study methodology. Thank you.